Good evening, ladies and gentlemen. Today I have with me Jaspreet Singh Arora, the Head of Research, the Chief Investment Officer at Research and Ranking. Jaspreet carries with himself a 17-year experience of working across various broking houses, leading research teams into picking great stock ideas for investors. Today, he is going to talk about how to create wealth during the current volatile times that we are going through. He is going to answer a lot of questions that investors have in their mind on where the stock markets, on where the economy is headed. Over to you, Jaspreet.
Hi, good evening, everyone, and thank you so much for your participation today. Um, looks like an interesting week because we've had a fair amount of positivity that's been there on the index and the broader market after a long time for most part of July. So just to run through what will be our deliverables today. It is these 5 points. What's the current state of the economy? What's our sense? What do we make out of it? What's the market outlook? What's the some bit of discussion around our portfolio built up? What's the investment philosophy that we are following and the stock selection criteria? And last, what we try and do is sum it up with some food for thought is how do we correlate the change in intrinsic value with the fall in stock prices? Okay, so starting with the first one, um, which is just to start. India is facing a combination of once in a century medical crisis with once in a decade financial market crisis. So even though the COVID cases have been rising, but at the same time, what we are also noticing is that the resilient India has picked up business activities in a much calibrated manner, which is kind of helping the economy at large. uh, Within that, there are certain sectors which are doing well, like which is essentials and the semi-essentials, which is largely FMCG, telecom, agri, pharma. While the ultra discretionary like hotels, entertainment, aviation, reality, multiplexes, that is going through a phase of turmoil and is possibly expected to continue for some more weeks, possibly some more months. All depends on the situation, which is very dynamic. In terms of the equity market, we'd seen a very knee jerk reaction in the month of March, which was a negative 23%. April was equally sharp and it bounced back. The Nifty bounced back 15%. In the month of June, in the month of May, we were about flattish. June we had positive 8%, and July till date we are again positive 7%. If I look at the year till date, which is Jan till date, the Nifty is still down about 10%. While when we compare this with the Dow Jones, it's minus 8%. S&P is largely flat. It's about minus 1%. FTSE is about 18%, and 20% is the Russian index. So we are neither as well off as a US market, which is possibly not seeing as much impact just because the indices and most of the stock prices there have bounced back. And also, we are not as impacted as reflected from the benchmark indices when compared to, let's say, indexes such as the Russian or some of the European nations. Okay, and what do we have so far? See, the 1Q season has already started about 2 weeks back, and you would notice that it's been a mixed bag so far. And it's very important. There is a reason why I'm highlighting this. There was this belief that 1Q is going to be a washout. I mean, just like and washout is a very nice term I'm using. It was, there were terms like we've never quarter like never seen before, and things like that. However, to the contrary, the results have been very very encouraging. Still early days, but yeah, this is no less a sample, to take a clue out of. So out of the 14 large cap results out so far, we have 7 which are the green ones, right, which is Infosys, Wipro, HDFC Bank, SBI Cards, Britannia, HUL, which have not only delivered superior performance, they have also given a fantastic outlook. And again, this is relative, right? The outlook is again relative to what the outlook that they had shared a quarter back for the balance part of financial year. While there are 4 stocks, again, from various sectors, HCL, Mahindra and Mahindra Financial, ICICI Lombard and DMart, where the results was just about okay, yeah, or slightly positive. While the negative ones have only been 3 so far. When I'm saying again negative, it's been results possibly not matching up to the larger street estimates. That's been TCS, Bajaj Finance, and HDFC Life Insurance. So clearly, the number of stocks which have outperformed or over delivered, commentary is positive, is a good 50%, and that obviously gives us a bunch of confidence to take into the balance part of. And as you can see, there are stocks within the same sector. In IT, TCS could not possibly deliver. Infosys and Wipro delivered, and HCL Tech was mildly positive. So it's a mixed bag, right? So it's that case of mixed bag being there is across. It's not that it's just happening from a particular sector. Okay, so what do we have? I mean, there's a whole bunch of points that I've noted down, but and that's a little for casual or leisure reading. But let me just pick up some of them. Right? What's been the negatives, the positives, and the neutral announcements so far, or the news so far? So negatives again. India has been one of the first affected nations. Number 3 so far, 11 lakh plus cases. Major towns, Mumbai, Delhi, Chennai, Ahmedabad, all of them being impacted the most. But the positive is the recovery rate is increasing day by day. It's still high, and the mortality rate is low, right? And while all this is going on, we've kind of get all this time to set up our healthcare infrastructure, just in case it doesn't improve in the near future. In terms of the GDP, that was expected to decline in current financial year, not only in India but globally. But at the same time, if I look at the positive side of it, it is expected to rise, possibly equally sharply in FY22. So if it's going to decline by 5% this year, it's going to rise by 9% next financial year. And so is the case with other major developing and developed economies. It's just that the case with India is the rise is expected to be reasonably sharp and high single digit. And these are not our estimates. These are from the big global agencies. So it comes with a fair bit of confidence and a fair amount of work gone behind that. In terms of the other issues which were there, which was there till about 2 weeks back, which was the border tensions between India and China, in terms of initially with the military on the military side, and which kind of escalated, and government have had to take steps to tone it down in terms of banning some of the apps and not giving preference to some of the government contracts. That was obviously spooked the market initially, but after that you had various news coming in, like the GST collections was 90,000, almost 91,000 crore for the month of June, just 10% short of the 1 lakh crore average that we've been doing till Jan. So we are just 10% away from our normalized collections. So if July happens to be anywhere closer to 1 lakh crore, you can very well say that we are coming very close to normal. And this obviously improved significantly versus the April and May collections. Um, the FIDI buying was very healthy in the month of May and June. July continues to be the same. And there was some good offerings, quality offerings from big giants like Lever, HDFC, Bharti, Kotak, and not to, I mean, the list is incomplete without mentioning the biggest of them all, Reliance Industries, which lapped up billions of dollars from the global giants. Uh, in terms of the data, the core growth, the decline went down significantly in the month of May. So steel production decline was much lower. The power decline was much lower, 16%. The electricity consumption was just 6% decline in the month of June, while it was as high as 24% decline. And see, this is a very good barometer of the kind of economic activity happening at the ground, right? Because any activity at within a household, in the industrial area, right, within services sector, anywhere, uh, has got to involve the consumption of electricity. And if the electricity consumption contracted 24% in the month of April, that showed the kind of impact it had on the economy. That same number was only 6% down in the month of June, and possibly July should be more towards the flattish side. So these are healthy trends that we are seeing. The unemployment rate has gone down drastically, and also the overall business outlook as measured by the composite PMI index, which is a combination of both services and manufacturing output, has inched up to 38 in the month of June versus 15 in May, and we are just inching closer to 50, which is the normalized level. So to summarize, on all areas, on all aspects, the ground movement is coming as close to normal. Okay, so let's look at this is more relatable, right? Because we would use these items on a day-to-day basis, or would have done it in the last month, maybe doing it in the next month. Two-wheelers in rural and urban India, if they were selling 100 units in the month of Jan, or let's say in the month of February, which is what we call pre-COVID period, it sold about 75 units in rural and 65 units in urban India in the month of June, end of June and early July. And believe me, this is early July. Right now, we are just about approaching the end of July. This is getting better week after week. The four-wheelers was 50%. Tractors was more than 100% compared to pre-COVID levels. FMCG was obviously, I mean, it's a no-brainer that everybody was munching, the snacks and the Maggies and the biscuits, and therefore, the growth had to be there. Certain brands, certain categories grew 20%, 30%. Britannia grew 26% revenue growth first quarter. Fantastic, unbelievable growth. Jewelry is still about 60%. I mean, we discussed, right? I mean, it's an ultra discretionary item. So if 100 units were being sold pre-COVID, right now we're just about selling 60 units, which is understandable. Possibly jewelry, real estate, entertainment, multiplex is possibly some of the last set of activities people would want to do, unless it's very compulsory. Similarly, insurance and mutual fund products, we're getting close to normal. Paints, again, a good barometer of activity at the ground level, 75, 80%. Consumer durables is as good as 80, 85%. Washing machines, in fact, did a growth of 20%. Yeah, obviously, I mean, with the absence of house helps, we had no choice but to go out and buy more of washing machines, dryers, more of second-hand refrigerators and things like that. Cement and steel, again, a good barometer of the activity at the ground level, is getting as close to normal as possible. So cement is selling almost like 85 units or more compared to what it was pre-COVID. So and believe me, the next time we discuss this, some of this would be 90%, some of this would be 100%, some of it will still languish at 60-70%, but that's going to be more at the ultra discretionary side. But a large part of the economy is expected to converge to normalize. Okay, this is where we find this activity really interesting. So innovation at its best. We highlighted in our last webinar how the likes of Tanishq, Asian Paints, Amul, HUL, Dabur, they had launched a flurry of products to ensure the customers are satisfied and they get what they would want at this stage. Similarly, the last two weeks or let's say 4 weeks, we have seen the company Orient Electric, they launched they've launched 100% what they call UV Sanitech machine, through which you can it kills 99.99% bacteria and viruses, including corona, in just flat 4 minutes. And the beauty is you can add at once or together put things like a mobile phone, a keys, your car keys, a watch, perishable items like fruits, all in one together inside that machine, just like a microwave machine. And in flat 4 minutes, it's all disinfected, right? And what better time and how quickly they have come out of this product, and it's now available on a pan-India basis. That's the kind of innovation companies like Orient Electric are doing. Next is, Zodiac has launched its shirts, which they claim that it kills 99%. Obviously, we're not saying it is all foolproof, and we have tried this, we have tested this, and we are right. It just shows that there is some amount of activity. The companies are responding. They are to what the requirements is at the ground level. Neil Kamal launched a 4-in-1 bed, which was, if somebody wants to put a 100 seat bed in a hospital, Neil Kamal had that opportunity, had that bed through the metal what they made from its manufacturing units. Similarly, there was this Kochi-based robotic company which developed a robot which would just dole out sanitizers and face masks on a tray, and this is without human intervention. Dabur launched its face masks, N95 face mask. Maruti Alto had given the additional option of putting a partition if you buy a new car, and if you want a partition in case it's a driver-driven vehicle, and you want a partition, you could have taken it with just an additional cost of 750. And a company, Modern Bread, they launched Immuno Bread, where they had some ingredients which was supposed to be healthy, like turmeric and tulsi and so on and so forth. And they in fact they were giving a free mask along with every bread. So just the idea is to showcase that companies are reactive, responding to what the requirement at the ground level. Okay, so all of this is okay. What's the market outlook? Everybody wants to, and what's the things to watch out for? So as we said, the first quarter results have started. Things are not as bad as we would have thought it to be. The larger participants had thought it to be, and therefore it's kind of get also reflected in the indices. We are at 11,200 Nifty today, just less than 10% short of our February levels. So that's obviously the continuation of this not so disastrous results that will be keenly watched. There's obviously the US presidential elections in the month of November. That's also a very important event. And in India, just a state election in the month of Bihar, which is going to be keenly watched, because it doesn't seem like the government would try to do anything drastic between now and November, which will derail the economy. So hopefully we should not, if at all, there should be some positive measures to pump up or to boost the economy. So to conclude, there are some important points I wanna leave it to our viewers as takeaway and something which we strongly believe. Point number one, the lows of March is unlikely to be tested. And when I'm saying that, again, I'm saying largely at the index level, which is, I think we made about 7,500 at the Nifty. There's a fair amount of journey that we have traveled between then and now. Therefore, unlikely to be tested. The lockdown, because it's lifted in major parts of the states and at the national level, it's now only at regional level. The risk to economic loss is capped. Earlier, we were talking of the GDP degrowth also being possibly running into double digit. Now it's no more the case. It's very, very evident that the GDP degrowth would not, in an absolute worst case, would be still in single digits. And so far the consensus is -5. For all you know, we might end the year at a -2 or a -3 if things continue to improve. If first quarter is a washout, or if things turn the other way, our sense is please focus on the balance sheet and not the P&L. Look at the next financial year, FY22, and if you do that and you put the long-term average of a PE 18 to 22 times, the fair price range comes to 10 to 12,000. Now, this obviously, the moment you move into September, October, November, the market would start discounting FY22, right? And even if one takes nifty EPS of about a ballpark 550 against FY20, we closed at about 485. We're going to see a decline this year and then again climb. So even at 550, 22 times, we're just about at 11,000. But you would say if the next Nifty is fairly priced, or even if it goes to 12,000, that's less than 10%. Why should I put our money when there is less than 10% left at a broader level? So to address that aspect, what we suggest is please look at two aspects. One is consider using the staggered buying approach. Don't buy everything upfront. If anybody's coming in today, please do not put in more than 50% of your investable surplus. The next 50% can be divided into 25% tranches of 2 or maybe 3 tranches of, you equally divide the balance 50% over 3 tranches. Point number 2, and more important, is here we are not trying to buy Nifty. We're not buying a Nifty ETF. We're buying stocks, right? So even if the Nifty is less than, at a benchmark level, is less than 10% away from its high that it made in the month of Jan, but the reality is out of NSE 500, there are still over 200 stocks which are still available at more than 30% discount to what they were, or discount or a decline or a correct or a lower price than what it was available at in the month of January. And if you were to believe that the company will survive, its balance sheet is protected, it is supplying something which doesn't cater to ultra discretionary items, which is possibly going to face more brunt, like an airlines or to some extent multiplex or reality. Then there is no reason we should not be looking that particular stock and buying it. So all we are trying to do is at a portfolio level identify 20 stocks which are a buy, which offer a handsome opportunity even in today's context, irrespective the market is, or the Nifty is at 11,000. And believe me, you will definitely get 20 opportunities in which you can put at least 50% of your capital today. Moving on. Okay, we wanted to discuss two stock ideas this time, because we had some requests last time we did. Why don't we discuss some of the stocks that we've had held in our portfolio in the past, and we wanted to start with our one of the products that we have is mispriced opportunity, MPO. And one of the stock recommendations that we made is Hero Motorwalk in the month of April. And in less than 2 months, it delivered. Obviously, our expectation was that it would deliver the suggested returns in over 6 months, but but it just delivered it in less than 2 months. And we had strong fundamental arguments to back that particular idea. What were they? The company had a strong rural presence. Over 45% of its volumes come from rural, and rural, as you all know, is rural India is what is blossoming today. The good Kharif season, the Rabi sowing, the forecast is that we're going to have a good normal monsoon this year, and the government's obviously focusing on that side. That bodes well. The company has a very strong presence and a market share in the entry level bikes, as much as 70%. And that obviously, if you have down trading for people who would have bought, let's say, a 70,000 rupee bike in the month of Jan, and they still want to buy a bike, may have gone down to 50,000 as their ticket size. And Hero was the one which was offering maximum options in that category. And obviously, this is consensus that the preference was shifting and will continue to shift from a public transport to personal transport. And within that, motorcycles and bikes and two-wheelers is obviously more affordable category versus a four-wheeler. The input costs were soft, steel, aluminum. Company is strong, very strong in terms when it comes to balance sheet. A huge cash and equivalents that they have on their books, almost as high as 10% of the stock price, which was prevalent at the time when we had recommended this. No debt, free cash flow yield was 7%. 7% or more is considered high. Dividend yield 4%, fantastic. And to top it all, the valuations was very attractive, right? The P multiple was 11 times, and while the 10-year average was over 18 times. So you had everything going, and we couldn't have asked for more, and we were able to deliver. The stock was able to deliver 35% in less than 2 months. This is just to indicate or highlight a particular stock that we had recommended, and we had given an exit in less than 2 months. The stock has in fact gone up even beyond that exit price, and it's over 2,800 today. Deepak Nitrite. This is a company that we've held in our core portfolios, most of the core portfolios for the last almost year and a half, and in that period, it's more than doubled. Today it's a 7,000 crore market cap. And why did we like this stock? This I'm again discussing more from a long-term fundamental, just to give a flavor how we pick stocks and why we think they have been multi-baggers. It's been proven, excuse me, and they would continue to be that thing is we have a strong view that it's going to continue. So the opportunity for the Indian chemical players was huge ever since China clamped down on their local units because of pollution. Of late, the MNCs want to have a China plus one strategy. India fits in beautifully over there, because if there is one country which has all the resources in terms of infrastructure, manpower, the liquidity, the finance, and the associated logistics, it is which can give competition to China, it is only India. Second, they had put up a phenol acetone project in the month of November, and in less than 1 year of operations, it just reached 90% utilizations and attained a 65% market share. They've been focusing on downstream products, value-added products. They in fact set up a 30,000 MTPA plant in Dahej in April of this year of IPA, which, as you all know, is an important ingredient in the production of sanitizers. So they believe they're going to continue with this, and which we like is they're going to continue putting in more money in the value-added products, which is where much of that margin comes from. So they have a diversified product portfolio, which is another interesting thing, because if you're supplying to the likes of colorants, petrochemicals, agrochemicals, rubber, paper, textile, detergent, pharmaceuticals, that's a fair diversification. Couldn't have asked for a better mix. And top it all, the management, the pedigree, the leadership comes with a strong technical expertise in whatever they do. Just to highlight in terms of numbers, as we said, by in terms of revenue mix, it's fairly diversified. Colors is where bulk of their revenue comes from, and the balance is from other segments of agro, fuel, pharmaceuticals, etc. Geographically, also very important to note is it's fairly diversified, and the exposure to US is minimal. It's just 7%, and a majority of its exports and supplies are to countries in Asia, including Middle East and Europe, which is where the impact because of recent events has been minimal, as not as high as US. So it's well diversified. Another thing I want to highlight is the return on capital was as high as 35% in financial year 20, and the ROE was 46%. Obviously, it's going to go down because you have such a high base of net worth and capital employed, but it's still going to be a very, very healthy number of over 20% year after year for the next 5 years. It's almost averaging 25% for both return on capital and return on equity, which is very, very healthy. While even though the profit growth may come off because obviously you've had such a high base where profits more than tripled in FY20. However, after a small dip in FY21, our sense is there would be double-digit growth year after year for the next 5 years, and that's enough for this chemical company to continue to deliver superior returns. And mind you, this is just based on the projects that they have announced today, and they are not going to stop there, right? If it's throwing so much of free cash flow over 600 crores, like 400, 500, 600 crores, it's not going to sit on that cash flows. It's going to use that and put in more projects, and that is going to throw in more profit. So the profit growth should be much higher than what we are showing here. Just to give an indication. Okay, how do we select stocks? The investment philosophy. What's our investment philosophy and stock selection criteria? The basic tenets that we have is in terms of we like to have 22 stocks at a portfolio level. The market cap is that we prefer. The market cap mix is 67% of the total basket. So broadly, it means is if let's say 21 stocks is what I am recommending to our clients at this juncture. Anybody who comes in as an esteemed client today, I would typically give him 14 large cap and 7 mid cap stocks. This is as of today, right? When we believe that a certain section of the economy is impacted, we need to be a little cagey, and obviously we would have some cash, and we'll talk about it. But over a period of time, maybe 1 quarter, maybe 2 quarters, this mid cap and small cap allocation would increase from 33% to as much as 50%. So over a steady state basis, what we like to have is an even mix of large cap and mid and small cap. 50% large cap, 50% mid and small cap. That's what we would like to have on a steady state basis. That's our investment philosophy. What are some of the themes underlying our stock selection? Very important to know that, because you would associate, you would be able to connect with it. We try and ensure that the companies that we select are supplying to either an essential or a semi-discretionary product. So we would not, at this stage at least, would not offer you an aviation stock, a hotel stock, a multiplex, a high-end entertainment, a high-end vacation, and a jewelry, and so on and so on and so forth. Just doesn't fit into our, at this juncture, doesn't fit into our philosophy. Rural exposure is got to be high. Anything high on rural or exports would give a good balance to the revenue mix. The crude price decline would also be an enabler. As much as possible, we would like to have that as one of our tailwinds. Uh, Again, goes without saying, as less affected as possible to the COVID impacted states, cities, and we know by now, what are some of those pockets. Um, uh, you know, Greater than 70% of the stocks are the ones which are having less than 20% EPS decline. And why 20? I mean, why not 10? Why not? Okay, so the broad thought was when we started this exercise about 2 months back that the Nifty EPS would decline by 20%. So we said, let's look at companies which is going to decline lesser than the Nifty EPS. If this number goes down, and I'm sure it would, uh, then obviously our cutoff would be, let's say, if it's 15%, we would look at companies which are having a damage or a dent of less than 15% in the current year. Having said that, it should rise equally sharply in the next financial year. And whether they are using tech, they are using to drive sales, are they rationalizing fixed costs, are they doing product innovations? We discussed some of the companies in the previous slide. That that's going to be one of the factors. From a long term, some of the themes that we continue to like and try and ensure that it's there in our stocks is and it's a common theme, and we've been running it for over almost a year, is the per capita income doubling from the current 2,000 to $3,500 over the next 5 years. Is the company from the sunrise sector, which is healthcare, retail, insurance, entertainment. Is the company using technology as a disruptor? I'm saying more from a long-term perspective. Short-term, it's fine, but also from a long-term perspective, can the revenue of that company grow much higher than the nominal GDP growth? And is there a re-rating potential to drive to back the earnings growth? Because only then you'll get that compounder. And this is what I meant. If on the right hand side, what I said, and what I'm trying to highlight here is that essentially, if I'm looking at a 26% compounding over a period of time, next 3 years, 4 years, and 5 years, we are depending a majority of it on earnings growth, as much as 20%, which is over 75% of our compounding engine is dependent on earnings growth. Balance 6, 7, 10% is coming in from the PE rating. If it moves more, instead of 6%, it goes up to 12%. We would have compounding having much more than 30%. What's the broad buckets that we typically put our stocks? So again, let's say again, going back to that sample case of 21 stocks, we would typically have 9 or 10 today, in today's context, 10 stocks from the all-weather basket. What are these sectors? These are essentially the FMCGs, paint, the utility companies, and so on and so forth, which have delivered consistently year after year for the last decade. And they have delivered EPS, they have delivered growth in either low double digit or high double digit. And our sense is it's going to continue. So that's what we call the all-weather. The next bucket is where another 8 odd stocks would come in. 8 to 9 would be the business momentum, which is would be pharma, could be chemical, in building materials in today's context. But the condition is that they should be able to deliver earnings growth more than 20% over the next 4 to 5 years. Again, disclaimer: current year should not be treated as a normal year. If you exclude current financial year, exclude that, and then can it continue? Has it delivered, and can it continue to deliver in the next 4 to 5 years? And last is the circle of opportunity, which is where we would have not more than 2 stocks, where we think the either it's a turnaround story, or it's a mispriced, or it can deliver earnings growth which is far higher than a normal stock, which is so it should be able to deliver 40% average growth over the next 1, 2, or 3 years. So that's broadly the composition that we would have at this juncture. And some of the qualitative and quantitative parameters that we have is does the company have a good moat, leadership? Are there enough tailwinds from the industry? How's the company allocating capital? Are they buying Are they moving into putting additional money into related businesses or just absolutely new businesses? Or if they are looking at buying a ship and or aircraft or land, then obviously that's a big red flag for us. The disclosure standards, the corporate governance, holding structure, how well they came out from the last crisis, which was Demon or GSC or GFC. And obviously, we, for us, history tells us a lot of things. How well have they done in the last 5 or 10 years, in terms of the return on capital, in terms of the free cash flow, and this again is there are very very strict filters for at least the all weather stock, and a little liberal for the business momentum, and a far more liberal for the circle of opportunity, the ABC that we just discussed. And lastly, the promoter holding should be high. They should have a very high skin in the game, low, possibly relatively low on beta, pledging as minimum as possible, and getting obviously as minimum as possible. So this is how our current portfolios, a typical portfolio would look like in terms of the sector classifications. So as you would see, the BFSI, even today, in terms of the benchmark, it was, the representation was 42%. It's come down to 37 as we speak, and obviously it's the expectation is it would go down to less than 30%, but we have already trimmed it to 20% currently, given the headwinds that we expect over there. The biggest allocation is to consumer discretionary, and again here I'm highlighting more of semi-discretionary, the retail, the paints, the luggage, the footwear and allied, and also auto. That's the biggest basket that we have. Staples follows closely with 15% allocation. All the FMCG stocks. Chemical pharma is again a healthy 13%. That's a good space to be in the current juncture. The IT, media, telecom, more of IT and telecom is where we have 8% allocation, and the economy facing stocks, cement, steel, and allied. Infrastructure, that's about another 12%, and there are certain categories under miscellaneous that's at 7%. And this is dynamic, right? It's not that we would continue to follow this for any client coming in today and any client coming in 3 months later, any client coming in the Jan of 21. It is dynamic, right? We respond, we change as based on the situation. Okay, and lastly, I want to close the session with a food for thought, which is where we discuss the concept of intrinsic value. So what happens? This was more relevant in the months of March and April, but it still continues to be relevant because as we discussed, there are more than 200 stocks which are still available at a deep discount to what they were trading at in the month of Jan. So what it talks about is that the market is prone to erratic swings of pessimism and optimism. So we have to understand, appreciate, adapt, respond accordingly. There's no point trying to have a knee-jerk reaction and trying to sell, buy stocks at the high and sell at the bottom. So how do we define intrinsic value? So if intrinsic value is nothing but the discounted value of the cash flows, of the future cash flows of a company for the first 50 years, for the first 20 years, and the terminal value thereafter. So the first 20, if 100 rupee is the intrinsic value of a stock, the first 20 years discounted value is 67 rupees, right? And this is I'm taking this as a benchmark or as a case study. It would vary from sector to sector. The balance 33% is the intrinsic value, which is nothing. Is the perpetual value, which is the terminal value, which is after 20 years you assign a terminal growth rate and calculate the value. So it ranges again between 22 and 45%. We've taken an average of 33%. So the point we are trying to make here is, if the business is sturdy, if we believe in the management, we think the business is going to survive for the next 20, 30, 40, 50, 60 years, the impact of an event like this should not, in terms of the stock price, uh, be reflected beyond a certain percentage. And what's that percentage? It is this. If these are three scenarios, right? On the right hand side, you would see that the impact on the intrinsic value is less than 6%, even in scenario three. So let's discuss these scenarios. Scenario number one is that the crisis, like the current crisis, hits, it could be medical, it could be financial, hits once in 10 years. What it does is it knocks away 50% of my earnings of that particular year. And for simplicity, we are taking the discounted cash flow evenly divided over the 20 years. Obviously, this number would vary depending on whether the crisis hits on the first year or the 19th year or the 15th year. But for simplicity, it is taken as this for representation purpose. And believe me, the percentage change would not, instead of a 2% decline, it would be a 3% decline, nothing beyond that. So the crisis hits once in 10 years. The impact on the intrinsic value or the fair value is less than 2%. If the crisis hits like this, hits once in 10 years, but twice in the next 2 decades, then the impact is 3%. And third scenario is if the crisis hits in the fifth year, which is what the assumption earlier as well, but the impact on earnings was 70%, and it takes another year for it takes an additional year for the earnings to normalize. So that means year two also the impact is there, but not 70%, but 30%. Then, and it's again happening. It's happening twice. It's happened in the first decade, once in the first decade, and second time in the next decade. Then the impact is 6%. We can include another scenario where the impact could be even more higher than what we are projecting today. Believe me, the value of the intrinsic value would not change more than 7-8% even then. So the larger point we're making is, if the stock price of a good quality stock has corrected over 30%, while the intrinsic value has corrected, if it's according to our calculations, according to your calculations, it's not corrected more than 10%, that 20% is the circle of opportunity, you want to call it, or the moment of opportunity, the patience, the faith on the power of compounding, the faith on India as a growth story, all of that comes into play. So, to sum it up, as the guru said, the human mind is not trained to think about the long term. We just get influenced by the real time events and try and extrapolate them. So the idea is that to take advantage, if there's any knee-jerk reaction, one has got to take advantage of that and not get affected. And that is how comes our idea of building a portfolio, nurturing it and compounding it over a period of time, so that we've made a 3x or a 4x or a 5x over a period of time. Yeah, that's where I stop. Thank you so much for your patient listening, and over to Harsh for the Q&A.
Hi again. Jaspreet, we already have a lot of questions to you. The first question is a very interesting question. Do fundamentals matter at all? Or is it all about sentiment? And even then, the current market doesn't make sense.
Okay.
So what he's asking is it all about sentiments, or do fundamentals play any role at all?
Okay, yeah, so that's an interesting question. Thank you. I think it was from Salil that I noticed.
Yes.
Salil, thank you for your question. Very relevant, interesting. So this we've answered in our last webinar in detail, and you request you to have a look at it on either YouTube or on our website. It's right up there. But just to reiterate again, the market typically is driven by fundamentals, which is earnings, sentiment, liquidity, right? And there was this phase when till February the market was driven by nothing but earnings. Then there was this phase in between, which was largely the month of March and early April, when just sentiment took over. And after that, it was the combination of liquidity and sentiment which just led this pullback. I think we are slowly moving back to the zone where earnings would once again take over and start driving the individual stock prices, right? We are here trying to identify what will drive or derate stock prices. So from here onwards, a large part the of the movement in stock prices should be driven by earnings growth of that stock, and little bit and lesser to liquidity and sentiments. And we already seeing that in some of the stocks that are reacting based on their Q1 results. Look at Britannia, stock delivered 5% in the very next day after the results, when the management said that the commentary or the outlook was reasonably good and not as cautious as the market thought it to be. So coming back, it's gonna be stock specific. But let me just again highlight here is the fact that please look at next year earnings and not next year. By next year, I mean the financial year March 22, and that as a base year, and then pay your cards or invest in ideas that you like, and not based on the current year, because current year is obviously not the base or a relevant benchmark because of the event.
So, Jaspreet, the next question is with regards to the monsoons. With monsoons causing a havoc in many states in India, how do you see that impacting the economy, especially the rural economy?
So far, I think what we gather is it's affected largely the state of Assam and some part of NCR, but to the greater part of India, it's been above average, above average rainfall so far this year, which is very great, because it's a third consecutive year we are having that, and that bodes well for the economy at large. So don't see too much of a concern, except if there's a company which is having a dominant presence, a greater part of its revenue comes from the state of Assam and nearby states, then obviously there is a reason to worry. But otherwise, doesn't seem to be so big an issue so far.
The next question is a slightly detailed one. There are still sectors like the auto component, metal, power, public sector banks, and other PSUs, which are still far away from the ongoing rally. And in the same question, he says that I agree entertainment, hotel, and aviation could be the last you should participate on, but what about these sectors that we just asked?
So you said power, metals, and PSU stocks.
And auto components.
And auto components. Okay, great. Yeah, quite relevant. So we are actively exploring opportunities that are there in these spaces, and auto ancillary is definitely right up there in our probable names that we would want to advise our clients. See, the challenge is once you set a particular filter or a particular benchmarks that the company should have done A, B, C things in the recent past, and the recent past is obviously not 2 or 4 quarters, it's at least 5 years. So let's say it has to be at least a double-digit ROE or a double-digit ROCE, while throwing out cash at least once or twice in that period out of those bucket of 5 years. Then only you can take in some bit of confidence and roll it forward and try and see, can it do it better in the next 5 years. Otherwise, we would not like to tap this space beyond those two stocks out of 20 that we discussed, which is that circle of opportunity. So all this uh, uh, hope investments or so-called turnaround stories. Um, Even in the best of times, I don't think we would go beyond three stocks. So within this pack, auto ancillary, more of auto ancs is definitely interesting, and we is definitely there in the reckoning. The other three sectors very difficult given there's so much attractive opportunities available in the other spaces currently.
The next question is related to China, and he asks, "What if China falls or crumbles?"
Sorry, what if China?
What if China falls is one question. The second question is, what if China crumbles?
If China crumbles.
Yes, it has a big fall. The Chinese economy falls.
Oh, okay. So there are two aspects here. One is obviously if the manufacturing or overall activity within China deteriorates, obviously it would mean there's an opportunity for economies like India. So that's obviously the the better scenario analysis. The second obviously is that China's economy crumbling will obviously also have an impact on many sectors, including in India. Let's say, example, just like, steel prices in China collapsed 20% because the demand has collapsed 30% or more. Obviously, the domestic Indian or domestic steel prices would also go down because it's all based on import parity, and obviously the fortunes of Indian steelmakers would take a dent. So there are both positives and negatives, but net, if you ask me to summarize or take one stance, I think India should be a net beneficiary in case China were to face some kind of trouble in the foreseeable future. And let me just take the opportunity to highlight that for the first time in the last 18 years, India would be in a trade surplus, net trade surplus. What I mean by that is that we would have exported more than what we have imported. And why do I say that? Because the exports were not hit as much during April, May, and June. So what I'm quoting is more of the figure for June. The exports were hit, just about 10%, while the import decline was over 40%. And why was that? Because the demand for crude was down, the price of petrol, diesel was down, which is what our number one import is. The demand for electronics was down. The demand for jewelry was down. These are the top three import. Having said that, it does not mean it's going to continue year after month, quarter after quarter. But it just shows that it is possible. It is possible to be in surplus, and if we are able to do that, even in a couple of years from now, it would put India in a strong position, and obviously will have a good bearing on the currency, because our currency has been depreciating year after year.
How much gold should we own as a percentage of our portfolio?
Oh, so this is something that we don't specialize in. Possibly best to ask the wealth counselors or wealth advisors. But what we believe is in the power of equity, the power of compounding. Within that, what sectors, what market caps, small cap, large cap, mid cap, how much cash, what trend, what themes is possibly we would specialize in. Having said that, not taking away the fact that a person should invest in real estate, should have investments in debt, in gold, in banks and mutual funds, and equity, right? Because that's how you get that diversification, and not just. So it all depends, right? Whether you want to have exposure to equity up to 70% or 50% or 20%, depends on the risk profile, the age, the ambition you have in terms of multiplying your money, obviously through investing in fundamental ideas over a period of time. So I think given the current state of the market, I would be very, very tempted to put a predominant share of my money into equity.
Nifty is already trading at 28, 29 PE. How do you see this?
Yeah, that's true. That's true more from the as we call the TTM basis of the trailing 12 months. But if and that's obviously doesn't leave too much room for appreciation or growth from here onwards. But believe me, the markets is forward looking. Whether the current year decline is 20% at a Nifty level, or is it 10%? It would be done and dusted in the next couple of months, and we would then be discussing more of the next financial year numbers, which is March 22. And the moment we step into Jan of 2021, we would also start looking the possibility of the growth that one would start building in from the possibility of the year March 23. So with that aspect, as we shared in one of the slides, of near term, it looks like the market should head towards 12,000. I'm not saying it's happening next month. It could happen next quarter, but it's definitely heading towards that. But we are clear we are not advocating buying in the market or selling the market. We are looking at any point of time, we are looking at the top 20 juicy ideas that we think would give us 30-40% from that particular price point. And believe me, even at 11,000 index, I have more than a handful.
The next question is a little interesting. What is the right strategy to diversify my portfolio? Should I aim to minimize loss at this time, or should I go all out and take some risk?
Yeah, so that depends on as we discussed earlier on the risk profile, the age, the disposable income, the dependents that one has, and whether there are some EMIs and so on and so forth. But what on a broader basis, if I were to answer it, we would at this juncture, we are advocating not putting in more than 50% of the proposed investable surplus in. So even if I have an idea which is suggesting a 30% upside from the next 12 months perspective, even in that idea, we would not propose putting in more than 50% of the money. So let's say if I have built in a portfolio for a particular client for 20 lakh rupees, and to that particular stock, we recommend 5% allocation, which is 1 lakh rupee. We would not be advising putting in more than 50,000 at this juncture. The balance 50,000, as we said, could be deployed over the next 1 to 2 months or the 1 to 2 quarters, depending on how situation evolves. But the first 50% is important because you would be at least having a foot in the door. And tomorrow, if the market was to surprise positively, as it has been doing in the last month and a half, you would be not losing it out entirely. And the balance 50% is still giving me that room, the cushion, if there was a decline in the indices, and therefore, it's quite expected that even that stock would face correction. So if you get it at 10% cheaper, you can put another 25%. And if there's another correction, you can put in that last 25%. So that's how we would like to put it in context.
The next question is, and he's asked it twice, so I'll definitely ask it. How do we differentiate between value picks and growth picks in the post-COVID world that we are in?
Yeah, so one is obviously you've got to ignore the current year, or not ignore. I mean, just not put too much focus on the current year earnings, because that obviously is going to be dismal for a major part of the economy. So that's one way to look at it. while at the same time also not ignore the value stocks. So we're not saying that stocks like ITC and some tech stocks at one point of time they don't merit attention or investment, but it all depends on the mindset, the profile. With our profile, our kind of profile, we would typically be having more than we would be having a predominant share of stocks in the growth category than value, because we see that as so we believe in the concept of trying to compound at least 25% or more. Mandate is obviously 30% or more, but anywhere between 20 to 30% is a must. With that thing in mind, I think growth is where 95% of our time, energy, bandwidth goes. Yeah.
The last question I'll take for today is if I invest in chemicals or pharma, what do you think would be the outlook for the next maybe 1 or 2 years?
Okay, so we quite relevant question. I would want to answer it in two parts. One is obviously these are two different sectors we're talking of. So pharma, if you look at the aggregate earnings of the pharma companies 5 year back, um, let's say FY15, and if you do it compared with FY20, they're exactly the same, right? They've just not moved an inch, which means the CAGR is just not there. The earnings CAGR is just not there. Now we are in that phase where that compound or the earnings growth would pick up given whatever the situation on the ground, and also there are things like US FDA being a little more easy on in terms of the rules, regulations, and the covenants. So pharma is more of, as I would call it, in the both would be in that in the pocket of B, which is business momentum, but pharma is I would say not as much a structural growth story as chemicals. Chemicals is given by now. It's not a cyclical. Chemicals used to be cyclical like a textile or metals commodities earlier, but and within chemicals again, it's specialty chemicals where we see a clear growth story, a structural growth story coming in. So what China grew in specialty chemicals in the period 2005 to 15, India is going to see that happening in the period between 2015 to 25. So even though we are halfway through, and that's just a guesstimate based on where we're standing, that 2025 may well be extended to 2035. We are just about halfway through. We have another 5 years of good structural growth still left in chemicals and within particular specialty chemicals. So that's there. And pharma also, just to highlight, one company is very very different from the other one. The formulations, the APIs, the which country geography you are catering to plays a are you a generic supplier? Are you an innovator? I mean, very very different. It's just not like a cement or steel where there's very little to differentiate between one product and another. And you would notice this. I mean, some companies are trading at 9p, some are at 19, some at 29, and the MNCs are at like 39 and 49 and 59. The Abbotts and the Glaxo, Pfizer, Sanofi's, they're all at 40 plus P for a reason. So it's a very to summarize, I think within this long-term growth opportunity, structural opportunity is the chemicals basket. Pharma is more momentarily. Also, when I'm saying this is also because the pharma has had the best ever run in a 2-month period, which happened in the month of end of March till early mid-May. So mid-March to mid-May, the index has gone up 40%, and we did not see the index go up 40% in the last 5 years. That 5-year return has come in just 2 months. So with that thing also in mind, one has to take a step back and ask, am I paying the right premium, or just too much for a company in pharma.
So just before we leave, if you had one thing to tell our listeners, what would that be?
Okay, so yeah, just want to go back and reiterate the view, or the point that I made is belief in the power of equity, the power of compounding, the India growth story, and if one takes a view, if one is of the belief that we will come out of this sooner than later, stronger than weaker, smarter than not so smart earlier, then there is no reason why one should not be investing. And as I said, just remember that the two things that I mentioned, the two S, the stagger based buying, the stagger approach, and the stock specific approach. Very simple. Stagger your investments. Don't put in upfront and stock specific. We're not buying an FT ETF here. We're just buying specific stocks, right? And believe me, there are at any point of time, because of sector rotation, because of market cap rotation, because of theme rotation, there would be, we're just looking at 20 opportunities. We're not looking like a 40, 50, 60 opportunities. Believe me, 20 opportunities are there. We just got to go deeper and have that conviction whether we believe in this stock at this point of time, that it will give me that desired 20, 25, 30% growth at the portfolio level over the next 1 year.
Thanks a lot, Jaspreet.
Pleasure.
Thank you very much. And if you have any more questions for Jaspreet, this is not the end. Please write back to us at createwealth@researchandranking.com. And I'm sure I will put those questions across to Jaspreet. And if we have anything to answer, I will cover them in the emails that I send across. Thanks a lot. Thanks, Jaspreet, once again.
Thank you. Look forward to talking to you the next webinar.